The inverted hammer pattern is a key indicator in the trading world that signals a potential bullish reversal. This pattern forms when the price of an asset falls after the market opens, but then closes near its opening price, leaving a long upper shadow and a small body at the bottom. This visual suggests that, despite selling pressure during the trading period, buyers managed to push the price up, indicating potential bullish momentum in the following sessions. Understanding and identifying the inverted hammer can be pivotal for traders. It encourages them to look for signs of a reversal in downtrends, offering opportunities for entering a market at the early stages of a potential upswing. However, it is crucial to note that the inverted hammer should not solely guide trading decisions. Confirming the pattern's prediction with additional indicators or market factors is often necessary for making more informed decisions. In conclusion, integrating the practice of identifying and interpreting patterns like the inverted hammer into trading activities can provide valuable insights. However, the dynamic nature of trading markets underscores the importance of continuous learning and adaptation. Staying informed about different trading patterns, market movements, and complementary analytical tools can significantly enhance trading strategies and ultimately contribute to more successful trading outcomes. Candlestick patterns play a crucial role in technical analysis, offering visual insights into market sentiment and potential price movements. Originating from Japan over hundreds of years ago, these patterns are formed by the open, high, low, and close prices of a financial instrument over a specific period. Through various shapes and configurations, candlestick patterns help traders and investors understand the balance between supply and demand, ultimately guiding trading decisions. One notable pattern within this analytical toolset is the shooting star, which often signals a bearish reversal. This formation appears after an upward trend and is characterized by a small lower body, a long upper wick, and little to no lower wick. The small body indicates that there was little movement from open to close during the trading period, while the long upper wick signifies that prices were driven higher but encountered enough selling pressure to pull the prices back down significantly by the close. The appearance of a shooting star suggests that the buyers initially had control during the trading period, pushing the price upward. However, the sellers eventually overpowered them, driving the price down from the high to close near the opening price. This battle between buyers and sellers casts doubt on the continuation of the bullish trend and hints at a potential shift in market sentiment, possibly indicating that a peak has been reached and a reversal to the downside could be imminent. Investors and traders closely watch for the shooting star pattern, among others, to make informed decisions about their positions. Its identification, coupled with other analysis tools, can provide valuable insights into the potential future movements of market prices, assisting in the optimization of entry and exit strategies. The shooting star candlestick pattern is an indicator often used in chart analysis to suggest a potential bearish reversal in the market. It is characterized by a small lower body with a long upper wick and little to no lower wick. The body of the candlestick, which represents the difference between the opening and closing prices, is located at the lower end of the trading range. The long upper wick shows that buyers drove prices up at some point during the period, but by the close, sellers had countered these gains, pushing prices back down to near the open. Visualizing the shooting star without actual charts, imagine a scenario where during a day of trading, optimism initially leads to a sharp price increase. However, this optimism is not sustained, and by the end of the trading session, prices fall to close just above where they opened. This pattern appears like a shooting star falling from the sky, with its tail up in the air, which is how it gets its name. The presence of this pattern, particularly after a period of upward market trend, signals to traders and analysts that the momentum could be shifting from buyers to sellers, indicating a potential downturn in the market. In diverse market contexts, the shooting star remains a signal of hesitation among buyers or a struggle for control between buyers and sellers. For example, in a bullish market, its appearance signals that despite continuous upward trends, sellers are beginning to push back, challenging the prevailing momentum. Conversely, in a more volatile market, the shooting star suggests that although buyers attempted to dominate the market at certain points, their efforts were ultimately unsuccessful, hinting at a growing bearish sentiment. It is crucial for traders to consider confirming signals and the broader market context when interpreting the shooting star pattern to make informed trading decisions. While it is a strong indicator on its own, integrating it with other analysis tools can enhance its predictive power and reliability. The shooting star is a candlestick pattern that signals a potential reversal in an uptrend, hinting that a bearish movement may be on the horizon. To identify a shooting star, there are specific characteristics to look for in its shape, size, color, and the length of its upper wick. Firstly, the shape of the shooting star looks like an inverted hammer. It has a small body at the lower end of its trading range, with a long upper wick that typically measures at least twice the length of the body. The color of the body can be either red or green, though a red body is often viewed as more bearish. However, the most critical aspect is not the body's color, but rather its position after an uptrend and the prominence of the upper wick, suggesting strong selling pressure after the opening. The length of the upper wick is crucial as it indicates that buyers initially drove the prices up, but sellers eventually overcame them and pushed the price down near the open. This rejection of higher prices is what gives the shooting star its bearish implication. The pattern's position within an uptrend is equally important for its accurate interpretation. For a shooting star to be considered valid, it must occur after a significant uptrend. This context is crucial because it signifies a potential exhaustion of the uptrend, highlighting the transition from bullish to bearish sentiments among traders and investors. To better understand the shooting star's implications, let's look at chart examples. Imagine a scenario where a stock has been in an uptrend for several weeks, consistently reaching new highs. Suddenly, a candlestick with a small body at the lower end and a long upper wick appears. This is our shooting star. Its significance is heightened by its position after a series of green candles indicating bullish momentum. The appearance of the shooting star suggests that despite the bullish trend, there's significant sell-off at higher price levels, signaling that the bulls are losing control and a bearish reversal might be imminent. In different market conditions, the shooting star can serve as an alert to traders. Whether in stock, forex, or commodities markets, its appearance warns of potential trend reversals, urging traders to consider protective measures like tightening stops or taking partial profits. The reliability of a shooting star, as with all technical analysis tools, increases when combined with other indicators and analysis methods to confirm the potential reversal. The shooting star pattern in the context of financial markets signifies a potential shift in market sentiment from bullish to bearish. This pattern is characterized by a trading day where the market opens and prices rise significantly during the session, but then fall to close near the opening price. Visually, this leaves a candlestick with a long upper shadow and a small body at the bottom, resembling a shooting star in the night sky. The significance of the shooting star comes from what it indicates about the psychology of traders. Throughout the day, the bulls are in control, driving prices higher. However, the pullback by the end of the session suggests that bears are beginning to exert pressure, overcoming the bulls' momentum. This tug of war between buyers and sellers, with the sellers starting to gain ground, can make the shooting star a harbinger of a bearish reversal. The presence of a shooting star after a period of bullish momentum in the market can often signal that the uptrend is losing strength. Many traders and investors view this pattern as a warning that the current market dynamics are changing. The rationale behind this interpretation is that the inability of the bulls to sustain high prices by the close of the trading session exposes underlying weaknesses in the bullish trend. As a result, the shooting star pattern can lead to a change in trader behavior. Traders who may have been previously looking to buy assets might become more cautious or start considering selling, anticipating a downturn. Likewise, those who were on the sidelines might see it as an opportunity to initiate short positions, betting on future declines. In summary, the shooting star pattern is a valuable tool in technical analysis, offering insight into shifts in market sentiment and trader psychology. By signaling a potential reversal from bullish to bearish conditions, it prompts traders and investors to reevaluate their strategies and prepare for possible changes in the market direction. The shooting star is a candlestick pattern that traders interpret as a sign of a potential bearish reversal. This means it suggests that the current upward trend in the market might soon turn, resulting in a downward movement in price. The pattern is recognized by a small body at the lower end of the trading range with a long upper shadow and minimal or no lower shadow. It typically forms when the price opens, rises significantly during the period, but then closes near the open again, indicating rejection of higher prices. To fully understand the implications of a shooting star, one must consider the surrounding market context. For example, when a shooting star forms after a prolonged price increase, it may signal that buyers are losing control and that sellers are starting to push back, potentially leading to a reversal. However, without confirmation in the form of a bearish candlestick or a gap down following the pattern, taking immediate action based solely on the shooting star might be premature. Chart examples play a crucial role in illustrating how shooting stars have led to various market outcomes. For instance, imagine a chart where a shooting star forms at the peak of an uptrend. If this pattern is followed by a significant bearish candle, it could be considered a strong signal for a reversal. Conversely, if the market continues to rise after the appearance of a shooting star, it might indicate that the pattern has acted as a temporary pause rather than a reversal signal. In some cases, a shooting star can appear during a downtrend but fails to lead to a continued decline. This could happen if it forms near a support level, suggesting that the downtrend might be losing momentum but not necessarily reversing. The key takeaway is that while the shooting star suggests a potential bearish reversal, its predictive power significantly depends on the subsequent price action and the broader market context. Traders often wait for additional confirmation before making decisions based on this pattern. Understanding the nuances of how and where the shooting star forms can provide valuable insights into upcoming market movements, making it important for traders to closely analyze charts and consider various factors before acting on this pattern. To understand the significance of a shooting star in technical analysis, it is essential to consider additional indicators and market conditions that help validate its implications for a potential bearish reversal. One such indicator is trading volume. Increased trading volume on the day the shooting star appears can strengthen its bearish reversal signal, indicating a higher level of selling activity as traders may be looking to exit their positions in anticipation of a market downturn. Another critical factor to consider is nearby resistance levels. If the shooting star pattern forms near a well-established resistance level, it could indicate that the price is struggling to break through this level, reinforcing the pattern's bearish reversal signal. This condition suggests that the market sentiment is turning negative and prices may start to decline. Furthermore, the trend preceding the pattern plays a decisive role in validating the shooting star. A shooting star is more significant when it appears after a prolonged uptrend in the market. This context is crucial as it indicates that after a period of buying pressure and price increases, the bearish reversal pattern suggests a shifting sentiment where sellers are beginning to overtake buyers, potentially leading to a downturn in price. In summary, the implications of a shooting star for a bearish reversal are strengthened by high trading volume on the day of the pattern, the presence of the pattern near a resistance level, and its occurrence after a prolonged uptrend. These conditions together provide a clearer and more robust signal that market sentiment may be shifting from bullish to bearish, potentially guiding traders towards adjusting their investment strategies accordingly. The shooting star pattern in technical analysis is noticed for its potential to signal a bearish reversal, suggesting that an uptrend may be about to end. This pattern emerges when, within an uptrend, a candlestick has a small lower body with a long upper shadow and little to no lower shadow. It visually represents a day where the market saw a significant push upwards, but then retracted to close near the opening level, indicating selling pressure. Historically, the shooting star pattern has been a valuable tool for investors and traders in forecasting market direction changes. Its appearance has often preceded downturns, offering a preemptive signal to those monitoring chart patterns. However, it is essential to acknowledge that, like all technical analysis tools, the shooting star pattern is not foolproof. Its predictive accuracy can vary, and it has its limitations. For instance, without confirmation in the form of a bearish candlestick or a gap down following the pattern, its reliability can be questionable. Furthermore, the importance of corroborating the shooting star pattern with other analysis tools cannot be overstressed. Combining it with other technical indicators such as moving averages, oscillators, or volume indicators can enhance its predictive power. Fundamental analysis, including economic indicators and company performance metrics, also plays a crucial role in making informed investment decisions. Therefore, while the shooting star pattern can be a powerful component of a comprehensive market analysis strategy, it should not be used in isolation. Investors are advised to use a multifaceted approach for market analysis to better navigate the complexities and uncertainties of financial markets. To effectively integrate the shooting star pattern with other technical analysis tools such as RSI, Relative Strength Index, MACD, moving average convergence divergence, and Fibonacci retracements, one can develop a more robust trading strategy by confirming bearish signals. Here is how each tool can be combined with the shooting star pattern. Firstly, the Relative Strength Index, RSI, can be utilized alongside the shooting star pattern to identify potential bearish reversals. When the shooting star appears during an uptrend, especially if the asset's price is seen as overbought on the RSI, typically above a value of 70, it suggests that the uptrend may be losing momentum and a reversal could be imminent. Secondly, the moving average convergence divergence, MACD, can provide confirmation of a potential bearish reversal signaled by the shooting star. If the MACD line crosses below the signal line close to when a shooting star pattern is identified, it can reinforce the likelihood of a downward price movement. This is because MACD is a trend following momentum indicator that can demonstrate shifts in momentum, which, when combined with the shooting star, suggests the uptrend may be weakening. Lastly, integrating Fibonacci retracements with the shooting star pattern allows traders to identify key levels of support and resistance. If a shooting star pattern forms near a significant Fibonacci retracement level, such as 61, 8% or 50% following a strong uptrend, it can act as an additional indicator that a reversal may take place from that level of resistance. An example of this integration in action can be seen in a real-world trading scenario where a trader observes a shooting star pattern form after a sustained period of price increase. Upon noticing this, the trader checks the RSI and finds the asset to be in the overbought territory. Further analysis reveals the MACD line has crossed below the signal line, and the price is at a key Fibonacci retracement level. Together, these signals provide a strong indication that the price trend may reverse, allowing the trader to make an informed decision to potentially exit long positions or consider entering short positions to capitalize on the expected downturn. By combining the shooting star pattern with these additional technical analysis tools, traders can enhance the robustness of their trading strategies, utilizing multiple data points to make more informed decisions and potentially increasing their chances of successful trades. Traders often encounter common errors and misconceptions when it comes to interpreting the shooting star pattern in technical analysis. One frequent mistake is acting on this pattern without confirmation. A shooting star suggests a bearish reversal only if it is followed by a decline in the next trading session. Without this confirmation, it is premature to make trading decisions based solely on the presence of a shooting star. Another misconception is overlooking the pattern's context. The shooting star is most significant after an uptrend. Identifying it in a downtrend or sideways market does not carry the same weight and is less likely to indicate a meaningful reversal. Ignoring volume is also a misstep. For a shooting star to be considered a stronger signal, it should be accompanied by higher than average trading volume on the day it forms. This signifies that the reversal has substantial market participation. To avoid these mistakes and improve pattern recognition and analytical skills, here are some tips. 1. Wait for confirmation. Look for a closing price lower than the shooting stars in the following sessions to validate the pattern as a bearish reversal signal. 2. Consider the market trend. Ensure the shooting star appears after a significant uptrend. This context strengthens its relevance as a reversal indicator. 3. Assess volume. Analyze trading volume on the day the shooting star forms. An increase in volume supports the validity of the pattern. 4. Study the overall market. The shooting star is just one tool among many. Incorporating other technical indicators and market analysis techniques will offer a more holistic view and reduce reliance on a single pattern. 5. Practice and learn. Continuously observe and analyze real market scenarios where the shooting star appears. Experience and practice will enhance your ability to interpret this pattern effectively alongside other market signals. By being mindful of these common pitfalls and adopting a comprehensive approach to market analysis, traders can refine their interpretation of the shooting star pattern and make more informed trading decisions. The shooting star pattern in the context of technical analysis suggests a possible bearish reversal, typically occurring at the peak of an upward trend. This candlestick pattern is identifiable by a small lower body and a long upper shadow, which signifies that the price was pushed up but encountered selling pressure that brought it down to close near the open. To leverage the shooting star in setting entry and exit points for trades, traders often wait for additional confirmation the day after the pattern appears. Confirmation could come in the form of a gap down or a significant red candle, indicating a closing price lower than the opening price following the shooting star. If this confirmation occurs, traders might consider entering a short position or selling existing long positions to capitalize on the anticipated downward movement. As for exit strategies, traders could set a stop-loss order slightly above the high of the shooting star to minimize potential losses if the market movement opposes their prediction. A compelling case study involves a trader who observed the shooting star pattern at the top of a month-long uptrend in a well-known technology stock. This trader, recognizing the bearish reversal signal, waited patiently for the next day's trading to confirm the trend reversal. Upon seeing a large red candle that closed significantly lower than the shooting star's close, the trader entered a short position. To manage risk, they placed a stop-loss order just above the shooting star's high. Over the following week, the stock price declined steadily, allowing the trader to exit the position with a substantial profit. This scenario underscores the importance of confirmation and risk management in leveraging candlestick patterns like the shooting star for trading decisions. The shooting star pattern is a recognizable formation in technical analysis that signals a potential bearish reversal in the market. It appears after an uptrend, showcasing an opening and closing price near the bottom of the candlestick with a long upper wick and little to no lower wick. This pattern suggests that buyers initially pushed the price up, but sellers eventually overpowered them, driving the price back down to close near its open. Its recognition is crucial for traders in making informed decisions about potential market shifts. Variations of the shooting star include similar patterns like the inverted hammer and hanging man, each with unique trading implications. The inverted hammer, which occurs at the bottom of a downtrend, has a long upper wick and a small body at the lower end, indicating possible bullish reversal. Unlike the shooting star, the inverted hammer suggests that buyers are starting to outnumber sellers, potentially leading to a price increase. The hanging man pattern shares physical similarities with the shooting star, but occurs after a price increase. Its presence at the end of an uptrend signals a potential bearish reversal. The main distinction is its positioning, While the shooting star appears after an uptrend signaling a downward turn, the hanging man suggests buyers are losing control and a downturn may be imminent. Imagine a chart depicting these patterns. The shooting star stands out after a sequence of green candles, its long upper shadow casting doubt on the continuation of the uptrend. In contrast, the inverted hammer follows a series of red candles, its form offering hope for a reversal in fortune. Lastly, the hanging man hangs precariously at the end of an uptrend, warning of potential declines. Understanding these patterns allows traders to anticipate market moves. While these candlestick formations offer insights, they should not be used in isolation. Combining them with other analytical tools enhances their predictive power, offering a more comprehensive view of market sentiments and potential shifts.